Welcome back. I'm a 21-year-old investor looking to compound my wealth through the stock market. So in today's video, I'll be covering how exactly to understand the market and exploit some of the market misunderstandings that normally pop up. So for reference, this is my portfolio. I update this weekly on the channel, so feel free to check it out. So in today's video, I'll be actually covering Meta stock. So Meta is down around 20% from its all-time highs already. It is in a technical bear market. The stock is only up 6% year to date after being up more than 25% at one point. So for Meta stock, the current PE ratio normalized is at a 22 times of earnings. So why exactly is the stock down? So if you were to look at the earnings report as well as some of the news headlines on the day of the earnings release, over here it says Meta shares dropped 9% despite earnings beat as company takes one-time tax charge. So if you were to look at the headline, it will probably have been a bit scary. But if you dug into the numbers, income actually grew by a whopping 17%. Diluted EPS also went up by around 20% for the company. So the earnings were not as bad as it seemed. Besides that, if you have to go into the numbers also, daily active users went up by 8%, ad impressions went up by 14%, average price per ad was 10% higher than last year as well. Revenue up 26%, expenses up 32%. So let me try and explain a bit of the numbers over here, give you some color. So ad impressions as well as your average price per ad, they normally serve as counterbalance to each other. So when your ad prices increase, your average price, they tend to decrease. But in this quarter, it was actually an exceptional quarter for the company in terms of these two metrics. They both accelerated as compared to one quarter ago. So overall, the earnings were great. The company is doing well and going in the right direction. So why exactly is the stock down? So the stock is down because the company's management actually said that as a result, our current expectation is that capital expenditure will grow notably larger in 2026 than in 2025. So they're saying that they will increase their capex even more next year. And this year, they're guiding for around $72 billion of capex. Besides that, they also said that we also anticipate the total expenses will grow at a significantly faster percentage rate in 2026 as compared to in 2025. So this quarter alone, expenses went up by 32%. So we could see an acceleration in that department as well. So for Meta, this was why the stock was down. So besides that, the company is also raising debt. So they raised around $27 billion for this Hyperion data center. And as we mentioned in a previous video, they did it through a special purpose vehicle. So for Meta, there are currently two arguments that your bulls and your bears can have. So the bulls will say that Meta's earnings are great. The Meta's ROI is decent. But of course, you have the bears that are saying that Meta is wasting money. So we'll try and dive into these two portions to see which one fits the bill. So let's talk about the first argument, which is that Meta is increasing their overall capex. So Meta is increasing their overall capex, yes, but if you have to look at the earnings call from just Q1 of this year, this was what Mark actually said. So Zuckerberg actually said that the majority of the overall capex is still supporting the core business. And besides that, they are also leveraging on LLMs to improve content understanding. So what that means is a lot of the capex today, a lot of the money that they're pumping into the business is actually for the core business of the company. So Zuck said majority of the capex is now for the existing business. So what exactly is the ROI on that investment? So if you were to look at the ROI itself, a simple metric is just to look at the revenue. So when a company is pumping in capex, you expect the revenue to increase over time. And for Meta, as you can see here, the revenue is a lot faster than a company like Google, for example. So Google grew 13% last quarter. Meta is at a 21% revenue growth year on year. And since 2023, Meta's revenue has actually accelerated. So revenue is good. So this fits the criteria of ROI in a certain sense. And besides that, if you were to look at the ROIC metric as well, which is your return on incremental invested capital, it's a measure against a company's ability to generate returns on increased amount of invested capital. So when a company pumps in a lot of capex, we're trying to see if they can get returns from it. And based on this metric here, Meta's ROIC is also the second place, only behind to Google. So it's above Microsoft, it's above Amazon as well. And overall, this is clearly a stock that's now falling on rising fundamentals. So the second bad thesis that is driving the stock price today is that Meta could overbuild its capacity. So Mark Zuckerberg actually said that he's building for the best case scenario. He's spending a lot of money because he wants to capture the best case scenario if it comes. He doesn't know when super intelligence will come, but he said he's building in preparation for that. So bears today are saying that all the other hyperscalers, they are building now because they have an existing cloud business, but Meta doesn't have an existing cloud business. So if it overbuilds, then it could lead to a lot more depreciation in the future, which will hurt the company. So this is what Zuck actually said. He said the kind of very worst case would be that we effectively have pre-built for a couple of years, in which case, of course, there would be some loss and depreciation, but we'll grow into it and use it over time. So what he's saying over here is that it is used for the future. So either ways, there will be a certain level of ROI. So if the capex build out for the cloud portion doesn't have demand for it, then it can simply divert it away to the existing core business of the company. So if you were to contrast this to the other hyperscalers, this is another point I would like to raise up. So the other hyperscalers, for example, Azure is dependent on external demand. So it's enterprise demand from all the different companies. Amazon to a very large extent as well, although they can use it for their Amazon platform. Google as well is also dependent on external demand. So Meta on the other hand is saying that even if there isn't external demand, they can channel it to the existing business. So what Meta is doing over here is basically buying a call option as well as buying a put option. So they're buying a call option in case the demand comes. They're buying a put option by diverting it to the existing business if there isn't demand for it. Whereas all the other hyperscalers here, they probably don't have the ability to do it, besides Amazon and possibly a small portion of Google search. So besides all the bear theses that we covered earlier, there are some bull theses as well. So for Meta, you have many different levers to pull. So for example, your Reels have grown from 1 billion to 50 billion in just 3 years. You have threads coming up, you have Facebook, your ads, all of them are growing rapidly. And WhatsApp is a business that is also growing for Meta as well. So it's up around 59% year on year in terms of revenue for Meta, and it's a growing portion of the entire business. So Meta has a lot of untapped streams of income that the company hasn't explored yet. It hasn't explored taking a cut off the shops that advertise on Meta. They also haven't really monetized WhatsApp to a large extent, same for Reels. So if Meta is able to do so, then we could see a company with massive upside potential over the next few years. So a common misconception as well is the difference between Google Ads as well as Meta Ads. So this is exactly why Meta is doing so much better than Google, because Meta is more concentrated on small businesses, and what they do is they bring demand to all these small businesses. As for Google, they advertise to high intent buyers. So for example, if you search for a shoe on a platform, then Google will advertise to you, they won't actively find you. So for Meta, that is why the company is growing a lot faster in the ad division. They will continually do so because your small businesses, they have a lot more potential to grow over time. So for Meta, I think their ads are superior to Google, and they will continually stay higher growing as compared to Google. So before we end off this portion for Meta, let's talk about the valuation of the company. So this is in comparison to the other hyperscalers. So you have Google, Microsoft, as well as Amazon. Amazon is trading at a 35 times, Microsoft at a 36 times, Google is at a 28 times, although if you were to normalize it, the company is currently trading at a 30 times of earnings. Meta today, if you were to normalize the earnings, is currently at a 20 times of earnings, around a 20 to 21 times of earnings. So Meta is clearly a lot cheaper than the other hyperscalers here. So the final question is whether or not I bought Meta. So yes, I did. I initiated a small position in Meta just yesterday as well as today. I'll be continually adding on the way down. Hopefully it drops below $600 a share. That will be the optimal point of entry. And for Meta, I think it's a decent buy into a company that is high quality that the market is misunderstanding right now. Before you go, I have this Substack where I post write-ups, and feel free to check it out in the description below. The next stock that is misunderstood by the markets today is Booking. So Booking is up only around 3% year to date, lagging behind the markets. So for Booking stock, the main bear thesis for the company right now is that Gen AI will allow users to plan and book directly through that. But for Booking, what you need to realize is that 60% of their traffic is actually organic. So what that means is people go directly to their platform. They don't go through an LLM, they don't go through advertisements. They go directly to the booking.com site. And 15% is actually from Google search, which are high intent travelers as well. So Gen AI will continually target all those planners, but those with real intent will continually go to Booking, as shown in the strong organic traffic numbers here. So what Booking has done and what the CEO has said as well is that Booking is countering this bear thesis by partnering with your LLM companies. So for example, Booking is actually on ChatGPT right now. You can go on ChatGPT and search for Booking listings, and this is overall a positive development for the company. So besides that, this is what Booking has that all your different LLM companies and possibly up and coming disruptors can't have. So Booking has contacts with millions of hotels all across the world. And in order for an AI company to do that, to become the middleman, it has to get in touch with all these companies and all these hotels and create a network. And it is virtually impossible for them to do so. So Google will not do something similar as well, although I think they have the skill to do so, because 3% of the entire ad revenue is actually from Booking itself. So I'm sure they don't want to jeopardize that portion. So if you were to look at Booking as well as the secular growth trends for the company, so this is actually the Europe travel market. It is projected to grow at around 3% CAGR all the way until 2033. And besides that, the Asia market is projected to grow at around 9%. So if you were to weight it out, the average growth of Booking will probably be around 5%. That's the standard growth that I would expect for the company, assuming this trend continues. And of course, Booking being a large company in this space will probably grow a bit faster than this 5%. And if you were to add the shareholder yield for the company, which is currently now at around 5%, this is easily a 12% EPS growth for the company. So overall, I think Booking is attractive today, although I don't think the company is the multiest one out there, although I don't think the company is the one that has the strongest moat out there. I think it's presenting a decent opportunity today. I hope you guys have found this video useful and invest.